2026. Crash. Why markets are sliding. While everyone pretends everything is fine. The year 2026 began with whispers of unease in global financial circles, a sense that something wasn't quite right, though most people went about their routines as if everything was normal. Stock markets initially opened with optimism, fueled by official statements claiming economic stability, resilient growth, and healthy consumer confidence. On the surface, the headlines were reassuring. Market stable, economy shows resilience, and job growth surpasses expectations. But beneath these cheerful narratives, a quieter, more alarming reality was unfolding. Major indices were subtly shifting, trading volumes had started to thin, and volatility, though not yet dramatic, was increasing in ways that only experienced analysts could detect. This was the beginning of a market slide that few would fully understand until it was too late. Investors and everyday citizens alike relied on a combination of media narratives and governmental assurances. Financial news channels, newspaper columns, and even social media influencers were delivering a consistent message. The economy was strong, inflation was under control, and any fluctuations in the market were temporary and minor. This public confidence, however, masked the underlying fragility. Behind the polished charts and carefully worded press releases, corporate earnings were slipping, debt levels were climbing, and supply chain disruptions, left over from previous years' global crises, were quietly eroding profit margins. In essence, while the narrative was one of calm, the structural weaknesses in global markets were intensifying, setting the stage for a potential collapse. One of the key factors contributing to this hidden instability was the sheer scale of financial leverage employed by corporations and institutional investors. Borrowing at record low interest rates had allowed companies to engage in aggressive stock buybacks, prop up share prices, and maintain appearances of profitability. But as interest rates began to rise incrementally, borrowing costs started to squeeze margins, exposing companies that had overextended themselves. This wasn't an immediate disaster. Rather, it was a slow bleed. Investors, lulled by optimistic projections and reassuring corporate statements, failed to notice the subtle signals, rising debt ratios, declining cash reserves, and an increasing reliance on speculative gains rather than real operational growth. Meanwhile, retail investors played a major role in sustaining the illusion of stability. In the past few years, the democratization of trading through apps and social platforms had brought a flood of new participants into the market, many of whom lacked the experience to identify early warning signs. Fueled by hype, social media trends, and the fear of missing out, these new investors poured money into overvalued sectors, often following momentum rather than fundamentals. Technology stocks, renewable energy companies, and speculative cryptocurrencies became the darlings of the day, attracting capital at prices that defied traditional valuation models. On paper, this activity created a sense of vibrancy and optimism, but in reality, it was a fragile ecosystem reliant on continuous inflows of cash and sentiment rather than genuine economic strength. Global macroeconomic conditions were also playing a subtle but critical role. International trade tensions, lingering effects of previous energy crises, and geopolitical instability in key regions had introduced unseen pressures. Countries that had previously been economic pillars were now facing debt strains, trade imbalances, and currency volatility. Emerging markets, which had been a source of growth for multinational companies, were experiencing slowdowns in capital flight, yet mainstream financial coverage rarely emphasized these vulnerabilities. Instead, attention remained fixed on domestic indices and short-term performance metrics, creating a perception that global issues were distant and unrelated to local markets. Central banks, too, had a hand in this complex dynamic. After years of aggressive monetary interventions, including quantitative easing and emergency stimulus measures, economies were now highly sensitive to policy shifts. Even modest changes in interest rates or regulatory approaches could ripple across financial markets, influencing asset prices, investment decisions, and consumer confidence. In early 2026, small adjustments were made under the guise of normalization, yet these minor policy tweaks were enough to unsettle fragile portfolios and spark increased volatility. Hedge funds and institutional investors, constantly monitoring these developments, began repositioning, moving capital away from high-risk assets and into perceived safe havens, a process that added to the underlying tension without drawing widespread public attention. As the first quarter unfolded, the divergence between reality and perception became increasingly stark. Everyday people, reassured by the media and official reports, continued to invest, spend, and plan for a stable economic future. Corporate executives, pressured to maintain appearances, continued aggressive buybacks and earnings projections. Analysts issued optimistic forecasts, often relying on outdated models that failed to capture the accelerating fragility beneath the surface. And yet, in quiet corners of trading floors and private financial forums, seasoned investors were beginning to whisper about a coming correction. one that could be sharper and more prolonged than most were prepared to handle. Psychology played a crucial role in perpetuating the illusion. Humans by nature are inclined to seek stability and normalcy, often dismissing or rationalizing early warning signs. Cognitive biases, herd behavior, and confirmation bias meant that even well-informed individuals tended to ignore contradictory evidence if it clashed with prevailing narratives. This collective denial was particularly dangerous in financial markets, where timing and perception often dictate outcomes as much as fundamental realities. The more people pretended that everything was fine, the more fragile the system became, creating a paradox where optimism itself contributed to systemic risk. By mid-2026, subtle cracks began to emerge more visibly. Select companies missed earnings expectations, bond yields rose unexpectedly, and market indicators started to display patterns reminiscent of past crises. Headlines began to reflect concern, but they were often couched in cautious, non-alarming language, ensuring that the general public remained largely unaware of the severity. Meanwhile, the financial elite, those with access to private data, alternative analytics, and hedge fund strategies, quietly began to hedge their positions, diversify into safer assets, and prepare for a downturn. This disparity between public perception and private action underscored the core tension of 2026. While most were pretending everything was fine, a small, informed segment was bracing for impact. As 2026 progressed into its second quarter, the first tangible effects of the underlying market fragility became undeniable. Investors could no longer ignore the subtle tremors that had been building beneath the surface. Stocks that had seemed invincible a few months earlier began to wobble. Technology giants that had fueled the market's momentum suddenly reported revenue growth below expectations, surprising analysts who had grown accustomed to unbroken expansion. Even sectors considered recession-proof, such as utilities and consumer staples, showed signs of strain. Corporate executives, desperate to maintain appearances, offered optimistic guidance, but the numbers told a different story. Shrinking margins, rising operational costs, and increasing debt obligations were becoming impossible to hide. The tension between public messaging and financial reality was reaching a critical point, threatening to unravel the carefully maintained illusion of stability. At the heart of this crisis was the disconnect between market perception and underlying fundamentals. Years of artificially inflated valuations, driven by cheap credit, quantitative easing, and investor exuberance, had created a bubble in both equities and alternative assets. While mainstream media continued to report steady gains and resilient growth, sophisticated investors were quietly warning of a reckoning. Bond markets, long considered a haven for conservative investment, began to reflect the growing risk. Yields on government debt in key economies started climbing, signaling concerns over creditworthiness and future inflation. This silent warning often went unnoticed by the average investor, whose attention remained fixated on the stock tickers flashing across television screens and trading apps. Retail investors, many of whom had entered the market during the boom years of 2024 and 2025, were particularly vulnerable. They had been conditioned to equate stock market participation with guaranteed wealth accumulation. Social media amplified this perception, with influencers showcasing short-term gains and creating a culture of fear of missing out. Yet the very dynamics that had driven this retail participation were now unstable. Momentum-based trading, leveraged positions, and speculative bets in overvalued sectors meant that even small disruptions could trigger outsized losses. When initial sell-offs began to occur, panic spread quickly, driven by fear rather than analysis. Unlike institutional investors, who had access to risk management tools and hedging strategies, many retail participants were exposed to full downside potential, making the market increasingly sensitive to minor shocks. Global economic factors only added fuel to the fire. Supply chain disruptions, which had persisted quietly since prior crises, now became more pronounced. Energy markets, previously buoyed by geopolitical stability and speculative investment, started showing signs of strain. Crude oil prices, while volatile, began to reflect underlying scarcity in certain regions, contributing to rising production costs across industries. Shipping bottlenecks, tariffs, and trade restrictions exacerbated corporate struggles, forcing businesses to pass on costs to consumers, thereby slowing consumption. While economists debated the nuances, the cumulative effect was clear. Companies were facing shrinking margins at a time when consumer confidence was beginning to waver. The role of debt in amplifying this crisis cannot be overstated. Corporations, investors, and even governments had leveraged heavily during periods of historically low interest rates. When small rate hikes were introduced as part of normalization, the ripple effects were immediate. Companies reliant on cheap financing struggled to service their obligations. Investment funds that had used leverage to magnify returns now found themselves squeezed, forced to sell assets at suboptimal prices to meet margin calls. This domino effect, initially imperceptible to the casual observer, began to accelerate. Each forced sale placed downward pressure on markets, triggering further sell-offs and intensifying volatility. What had begun as subtle tremors was now a rolling avalanche, threatening to engulf those unprepared for the scale of correction. Meanwhile, central banks faced a dilemma. Having spent years stabilizing markets through interventionist policies, they were now navigating uncharted territory. Any attempt to adjust interest rates or reduce liquidity risked accelerating the downturn, yet maintaining status quo risked allowing imbalances to worsen. Policymakers communicated cautiously, emphasizing moderation and stability, but financial insiders recognized the limitations of these measures. The invisible hand that had propped up markets for years was weakening, and the consequences of this shift were beginning to show. Currency fluctuations, rising yields, and international capital flows created a complex web of interdependencies that amplified the stress on global markets. Investor psychology played an equally critical role in magnifying the crisis. Optimism, once a stabilizing factor, became a source of vulnerability. Cognitive biases like confirmation bias, overconfidence, and herd mentality led market participants to underestimate risk and misinterpret warning signs. Even when initial corrections began, many assumed it to be a temporary blip, doubling down on investments in the hope of a rebound. This behavior, while rational in isolation, collectively intensified market fragility. Panic and euphoria became intertwined, creating a feedback loop where selling begets more selling, and hope delays necessary recalibration, only to make eventual corrections more severe. As news of early failures and missed earnings trickled into the public domain, media coverage began to shift. Headlines cautiously referenced market jitters, unexpected volatility, and corporate uncertainty, but often avoided dramatic language. This measured reporting inadvertently contributed to cognitive dissonance among the general public. People wanted reassurance and found it in the careful wording of news articles, ignoring the underlying trends that hinted at deeper systemic issues. The divergence between the reality experienced by institutional investors and the perception held by the public became increasingly pronounced, laying the groundwork for a more dramatic recognition of the crisis later in the year. By mid-2026, the first waves of panic began to manifest in tangible market movements. Sell-offs in high-flying technology and speculative sectors accelerated, while safer assets like gold, government bonds, and defensive equities attracted growing interest. Investors who had previously ignored warnings now scrambled to secure their positions, often triggering further volatility. Trading volumes spiked, but liquidity was increasingly thin, meaning that even moderate sell pressure could lead to significant price swings. The illusion of stability was cracking, revealing the underlying fragility that had been building for years. Institutional investors, meanwhile, leveraged their access to private data, alternative analytics, and hedging strategies to mitigate exposure. Hedge funds repositioned capital, sovereign wealth funds diversified internationally, and major corporations adjusted balance sheets to weather the turbulence. These moves, however, often had the paradoxical effect of amplifying stress for less sophisticated participants. As large players exited riskier positions, smaller investors faced falling prices and heightened uncertainty, further accelerating market instability. What began as a slow, almost imperceptible shift in fundamentals had now evolved into a visible slide, one that could no longer be dismissed as temporary. By the third quarter of 2026, the consequences of months of hidden fragility began to manifest more visibly, shaking confidence across global markets. The initial tremors, which some had dismissed as minor corrections, now revealed themselves as the early stages of a broader systemic crisis. Market indices that had previously seemed resilient started to fall sharply, sometimes dropping several percentage points in a single day. These movements were no longer confined to high-risk or speculative assets. Sectors previously considered stable, such as real estate, utilities, and consumer goods, began showing vulnerability. Investors began to understand that the crisis was not isolated. It was a multi-layered collapse affecting virtually every aspect of the financial ecosystem. Corporate debt emerged as one of the most immediate threats. Companies that had expanded aggressively over the previous years, using cheap financing to fund stock buybacks, acquisitions, or speculative ventures, now faced mounting interest obligations. Those with heavy short-term debt obligations struggled to meet payment schedules, forcing emergency borrowing or asset sales. In many cases, balance sheets that had appeared robust were revealed to be far more fragile than public statements had indicated. Analysts who had previously relied on optimistic projections were forced to revise forecasts downward, creating a feedback loop. As confidence fell, investors sold holdings, triggering further declines in valuations. This cascade was amplified by the highly interconnected nature of modern financial markets, where the failure of a single large player could send shockwaves across sectors and borders. Retail investors, many of whom had only recently entered the market, were disproportionately affected. Conditioned to equate rapid growth with safety, they were unprepared for sustained downturns. Social media, once a source of bullish momentum, now amplified fear. Platforms that had previously celebrated quick gains became arenas for panic, rumors, and speculation about impending collapses. Meme stocks, previously the darlings of retail enthusiasm, plunged as sentiment reversed. Margin calls forced individual investors to liquidate positions, often at significant losses, compounding downward pressure on markets. The very forces that had driven retail participation, herd behavior, overconfidence, and the fear of missing out, now accelerated the decline. International factors further intensified the crisis. Trade tensions between major economies, which had simmered beneath the surface for years, began to flare. Tariffs, sanctions, and policy disagreements disrupted supply chains, creating additional pressure on companies already struggling with internal debt and operational challenges. Emerging markets, which had been a source of growth and diversification, now faced capital flight as investors sought safety in established economies. Currency volatility increased, complicating international transactions and reducing the predictability of earnings for multinational corporations. In short, global interconnectedness, once celebrated for its efficiency, now acted as a conduit for systemic risk, transmitting localized problems across continents with unprecedented speed. Central banks and where regulators found themselves in a precarious position. Having spent years implementing policies designed to stabilize markets and stimulate growth, they were now confronted with a situation that defied traditional tools. Attempts to inject liquidity or adjust interest rates had unintended consequences, sometimes exacerbating volatility rather than calming it. Policymakers issued measured statements, emphasizing moderation and stability, but markets reacted to perception as much as policy. Investors interpreted cautious communications as signals of deeper weakness, triggering further sell-offs. The gap between policy intention and market reaction underscored the complexity of modern financial systems, where interconnectedness, leverage, and sentiment interact in unpredictable ways. Institutional investors, hedge funds, and private equity firms took divergent approaches to navigate the turmoil. Some sought to capitalize on the volatility, using complex derivatives and short positions to hedge or profit from declines. Others focused on preserving capital, moving into traditionally safe assets like gold, high-quality bonds, or cash reserves. These strategies, while rational from an institutional perspective, often had unintended consequences for retail investors and the broader market. Large-scale asset reallocation created sudden swings in liquidity, widening bid-ask spreads and amplifying volatility. The more sophisticated the players, the more effective they were at managing risk, but also the more they contributed to market instability for those without access to similar tools. Consumer behavior also began to shift, feeding back into the economic downturn. As financial news highlighted corporate struggles, rising unemployment risks, and declining asset values, households became more cautious with spending. Durable goods purchases slowed, discretionary spending declined, and housing markets experienced reduced activity. Companies reliant on consumer demand faced falling revenues, creating a self-reinforcing cycle. Weaker earnings led to layoffs or cost-cutting, which further reduced consumption, amplifying economic contraction. This economic feedback loop highlighted the deep interconnection between financial markets and the real economy, a connection often underestimated during periods of rapid growth. One particularly insidious factor was the psychological impact of uncertainty. Human behavior in financial markets is heavily influenced by perception, and uncertainty breeds risk aversion. Even those with strong balance sheets hesitated to invest or expand, fearing that the market slide could worsen. This collective caution slowed economic recovery and magnified market swings. Media narratives, though careful, highlighted selective failures, creating a climate of fear that was disproportionate to individual company circumstances, but justified when considering systemic risk. Panic, once it begins, is rarely rational. It spreads quickly, amplified by digital communication channels that did not exist in previous decades. The third quarter also saw the emergence of cascading failures in sectors that had previously been considered resilient. Real estate markets in key metropolitan areas, buoyed by low interest rates for years, began to stagnate or decline. Commercial property values fell as businesses closed or downsized, reducing rental incomes and impacting the balance sheets of financial institutions holding mortgage-backed securities. Energy companies, already strained by shifting geopolitical dynamics and rising operational costs, began to report losses. Even long-term infrastructure investments were affected. As uncertainty about financing and returns delayed projects, each of these failures, while individually significant, collectively created a broader narrative of instability that was impossible to ignore. By this stage, the market slide was no longer subtle. Volatility indices had spiked, trading volumes surged during panic selling periods, and interbank lending markets exhibited signs of stress. Governments, corporations, and investors were increasingly forced to acknowledge the reality that had been building for months. The disconnect between perception and reality, so carefully maintained in the first half of the year, was rapidly closing. Ordinary citizens began to grasp that the narratives of stability were misleading, and the implications for retirement accounts, home equity, and personal wealth were suddenly stark. The illusion of calm was shattered, leaving uncertainty as the dominant theme across financial markets. As 2026 moved into its final quarter, the full magnitude of the market crash became impossible to ignore. What had begun as subtle tremors in the first quarter had now evolved into widespread financial turmoil, affecting nearly every sector and economy across the globe. Stock indices that had been seen as symbols of stability plunged dramatically, wiping out years of gains in a matter of months. Corporate failures, once isolated, became increasingly common as debt obligations, declining revenues, and operational disruptions converged. The illusion of normalcy that had allowed investors and everyday people to feel secure was shattered, replaced by the stark reality that the global financial system was more fragile than most had imagined. One of the most striking elements of this crash was the speed with which confidence eroded. Investors, conditioned by years of steady growth and reassurances from corporate executives and media outlets, were caught off guard. Panic selling intensified market declines, creating a feedback loop where falling prices fueled more selling. Retail investors, many of whom had entered the market during the boom years and were heavily leveraged, faced devastating losses. Margin calls forced the liquidation of positions, further pressuring asset prices. Simultaneously, institutional investors moved cautiously, reallocating funds to safe havens like gold, government bonds, and cash reserves. This dichotomy, panic-driven selling from individuals versus strategic repositioning by institutions, amplified volatility and made recovery even more difficult in the short term. Corporate bankruptcies surged as the year drew to a close. Companies that had appeared profitable only months earlier revealed underlying weaknesses, from excessive debt to unsustainable operational costs. Major financial institutions, though resilient, were not immune. Their exposure to risky assets, derivatives, and failing companies created ripple effects throughout the economy. Internationally, emerging markets suffered as capital flight accelerated and trade imbalances widened. Currencies in vulnerable economies depreciated rapidly, inflation spiked, and governments struggled to stabilize domestic markets. The interconnectedness of the modern global economy, once praised for efficiency, now acted as a conduit for systemic risk, transmitting shocks with unprecedented speed and severity. Consumer confidence, a key driver of economic activity, collapsed. Faced with falling asset values, job uncertainty, and rising costs of living, households became increasingly cautious. Spending declined, slowing retail sales and affecting industries reliant on discretionary income. Housing markets, which had been buoyed by low interest rates and speculative investment, experienced declines in both prices and transactions. Commercial real estate suffered as businesses downsized, closed locations, or delayed expansion plans. The feedback loop between financial markets and the real economy intensified the downturn, illustrating how intertwined these systems truly are. Government and regulatory responses, though swift, struggled to keep pace with the rapidly evolving crisis. Emergency measures, such as liquidity injections and temporary rate adjustments, provided short-term relief but could not reverse the systemic vulnerabilities that had accumulated over years. Central banks faced a delicate balancing act. Easing too aggressively risked fueling future inflation, while tightening policies too quickly could exacerbate the downturn. Meanwhile, public perception of government effectiveness became increasingly critical. Citizens, witnessing the scale of losses in retirement accounts, investments, and home equity, demanded accountability and solutions. Yet the complexity of the crisis meant that clear, immediate remedies were limited, reinforcing the perception of widespread instability. Amid this chaos, financial innovation and alternative investment strategies came under scrutiny. The very instruments that had promised growth and diversification, leveraged derivatives, speculative cryptocurrencies, and complex funds, now exposed investors to unprecedented risk. Regulators and analysts began reevaluating these products, questioning whether their proliferation over the past decade had contributed to systemic fragility. Transparency, risk assessment, and the ethics of financial engineering became central topics of discussion as the world grappled with the causes and consequences of the 2026 crash. Psychology continued to play a pivotal role in shaping outcomes. Fear, uncertainty, and loss aversion drove decision-making more than fundamental analysis. Social media amplified both information and misinformation, creating echo chambers where panic could spread rapidly. Investors clung to narratives that provided comfort, even when reality suggested otherwise, and hindsight bias created frustration for those who recognized early warning signs. The collective psychological impact of the crash ensured that recovery would not be merely a matter of economics. It required rebuilding trust, confidence, and rational decision-making across markets and society. By the end of the year, lessons from the 2026 crash became increasingly clear. The crisis was not caused by a single event, but by the cumulative effects of overleverage, speculative investment, global economic vulnerabilities, and delayed recognition of systemic risk. It demonstrated the dangers of assuming stability based on surface-level indicators, and highlighted the critical importance of transparency, prudent risk management, and diversified investment strategies. Those who had prepared for downturns, either through strategic hedging or conservative fiscal planning, weathered the storm more effectively than those who had relied solely on optimism and momentum. As 2026 closed, conversations began shifting from panic to planning. Analysts emphasized the importance of understanding market cycles, systemic vulnerabilities, and the human factors that drive financial decisions. Governments, regulators, and institutions faced renewed pressure to implement safeguards to prevent similar crises in the future. Education on financial literacy, risk management, and critical analysis emerged as vital tools for investors of all levels. While the markets were far from recovery, the events of the year provided an opportunity to learn, adapt, and build resilience against future shocks. For reviewers following this unfolding story, the 2026 crash serves as both a warning and a lesson. It underscores the need to look beyond headlines, question assumptions, and remain vigilant in assessing financial health, both personally and within broader economic systems. Whether you are an investor, a professional, or simply someone concerned about the global economy, understanding the dynamics that led to this crisis can help inform smarter decisions moving forward. Staying informed, diversifying assets, and maintaining a cautious but proactive approach can mitigate risk in uncertain times. If you found this analysis helpful and want to stay updated on major economic trends, market insights, and deep dives into hidden financial realities, make sure to like this video and subscribe to our channel. By subscribing, you'll all get the latest updates on market developments and critical economic events that are often ignored by mainstream coverage. Don't miss out on our future videos, where we break down complex topics into clear, understandable insights so you can make informed decisions in an unpredictable world. Remember, the 2026 crash is a reminder that while markets may appear stable, vigilance, knowledge, and preparedness are the best defenses against financial uncertainty. Take the lessons seriously, review your investments, and stay aware of global trends. The story of this year isn't just about losses. It's about understanding risk, navigating complexity, and building resilience for whatever comes next.